There are two types of investors, one that looks like this and one that looks like this. I know what side I'd want to be on, and I'm sure most, if not all of you, would also choose the investing method that lets you build wealth with the least amount of stress and effort possible. And the awesome thing is, you can. And believe it or not, it's the smarter and financially optimal choice. The strategy is called dollar cost averaging. I know it sounds super complicated, but I promise you it's not. In this video, I'm going to share with you exactly what it is, how it works, and why I believe it's the best investing strategy for long-term investors, both beginner and experienced investors alike. Let's dive in. So what exactly is dollar cost averaging? In the simplest terms, dollar cost averaging is an investing strategy where you invest the same amount of money into the same security on a consistent and regular basis, regardless of its price. So for example, let's say Nicole works her budget and decides to invest $200 of her paycheck every month into security X. Every month, she would buy $200 worth of that security, irrespective of its price. So if in January the price is $50, she would buy 4 shares. In February, if the price drops to $40, she would buy 5 shares. And in March and April, if the price is $25, she would buy 8 shares. You can see what's happening here. By using this strategy, you wind up purchasing more shares when the prices are low and fewer shares when the prices are high. This results in lowering your average cost per share over time. In this example, Nicole would end up purchasing 25 shares at an average price of $32. But if Nicole had invested the entire amount in January, she would have only bought 16 shares for an average price of $50. Dollar cost averaging keeps you on track by preventing you from making poorly timed lump sum investments when the market might be at its peak. And at the same time, it ensures you're buying shares on sale when the market experiences a downturn. This is a good thing because while the stock market experiences ups and downs due to volatility in the short term, historically data shows that the market tends to recover and trends upwards over the long term. By lowering your average cost per share, you minimize the impact of short-term volatility in prices on your portfolio and can potentially enhance your overall returns over the long term. So let's say after 5 years, the price of this security goes up to $50. By dollar cost averaging, the value of Nicole's $800 investment would increase to $1,250. On the other hand, if Nicole had invested the entire amount in January, her portfolio would have seen no growth at all. That is the short and sweet explanation of what dollar cost averaging is, but you know I'm always going to serve you more. So if you're enjoying this video so far, don't forget to give it a like and subscribe. And now let's get into why it's my preferred approach. Going back to the earlier example, let's say instead that Nicole had come across a Reddit thread saying that the security price was expected to drop and she decided to hold on to the cash and ended up investing it all in April. Her average price in this case would only be $25. This strategy is called timing the market and could be thought of as the opposite to dollar cost averaging. It's an approach that attempts to maximize returns by predicting the best times to buy and sell investments. In theory, it sounds like a fantastic idea, but in reality, this strategy doesn't work. You see, the market is unpredictable. It's affected by so many variables that it's impossible to know what's going to happen next. Economic indicators, global events, and company news can all affect the market. While some people might get lucky, unless you have a crystal ball, there's no way you can consistently and accurately predict what the market is going to do. Look at this real-life example, for instance. This chart shows the historical performance of the S&P 500 stock market index, which is treated as the benchmark for the US stock market. The years highlighted in gray represent the 2008-09 Great Recession. During this time, the S&P 500 dropped in value by over 50%. Let's say at the point the market was down about 10% from its peak, you decided to invest $1,000 into a S&P 500 index fund. You may have felt pretty good about your decision momentarily, but I bet you wouldn't be feeling too great after the market proceeded to plummet a further 40%. It is virtually impossible for you or anyone else to reliably forecast market behavior. This fact is supported by academic research as well as studies involving real-world professionals. The truth is, no one knows what the market is going to do, and that includes economists, fund managers, the media, and especially the stock market gurus on Reddit. So no need to time the market because all the studies, all the data, and even the best investors admit that you can't. Dollar cost averaging removes the need to time the market. Instead, you're consistently buying in at different points. So you're buying here, 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 and here, regardless of what the prices are doing. Again, it prevents you from making poorly timed investments when the market might be at its peak, and it ensures you're buying shares on sale when the market experiences a downturn. This can lower your average cost per share and enhance your potential for better overall returns over the long term. In addition to eliminating the need to time the market and reducing your overall cost per share, dollar cost averaging has 3 key benefits for investors. First, and perhaps one of the biggest and most obvious advantages of dollar cost averaging, is its accessibility. You don't need a PhD in finance or have a ton of money set aside to invest effectively using this strategy. It's a simple and efficient method with no guesswork involved. If you're investing in a broad market index fund, it can also be relatively hands-off. And on top of this, you can get started with whatever you feel comfortable with. Simply put, anyone can do it. The second benefit is that it removes emotion and enables disciplined investing. Thinking long-term is a key aspect of disciplined investing. But with our personal finances and emotions being so deeply intertwined, this can be hard to do. After all, our financial situation affects our ability to meet our basic needs, pursue our goals, and maintain a sense of control. So even though we want to think long-term, things that happen in the short term can trigger strong emotional responses. Without a plan and strategy to guide you, when the market takes a nosedive, I guarantee you, panic will walk through the door and your logic is gonna peace out. And when the market looks hot, greed will creep in. It's human behavioral tendencies in response to fluctuations in the market, and we see it happen all the time. Emotional reactions often lead to people selling off investments during market downturns and buying back in when things are all rainbows and butterflies, the exact opposite of what you want to be doing. This is why Warren Buffett famously quoted, "Be fearful when others are greedy, and greedy when others are fearful." Dollar cost averaging acts as our emotional shield. By investing a fixed amount at regular intervals, you insulate yourself from the euphoria of market highs and the fear that accompanies market lows. You kind of put your financial commitment on autopilot. Rain, hail, or shine, you know you're in it for the long haul. The next key advantage of dollar cost averaging is that you can automate it. Remember that time you had to manually remind yourself to water your plants and it always ended up a crispy mess? Dollar cost averaging is like having a self-watering system for your investments. With the magic of technology, you can easily automate this strategy. You could direct a portion of your paycheck into a 401k, or of course, you could set up a recurring transfer from your bank account to an IRA or brokerage account. Select what you want to be invested in, and just like that, your money will be working for you while you sip your morning coffee, and you'll free up time and headspace to focus on other things. Now, there are some important things to take into consideration with dollar cost averaging. For a more hands-off investment approach, dollar cost averaging is more effective when applied to passively managed index funds as opposed to individual stocks. This is because they're a diversified investment and less volatile. Based on historical data, we know that broad market index funds are volatile in the short term, but trend up over the long term. The same cannot be said for individual stocks. Using dollar cost averaging to buy individual stocks without conducting thorough research into the company is a bad idea. Managing a portfolio of individual stocks requires ongoing monitoring and research. You'll need to stay up to date on company news, earnings reports, and industry developments. It's a lot more hands-on, so please keep that in mind when deciding what to invest in. It is of course possible to invest in a combination of the two as part of your diversified portfolio. If you're not sure, consider speaking with a financial advisor to align your strategy with your personal financial situation and goals. Secondly, this strategy works best for long-term investors. The time horizon you're investing for is extremely important. As we've been talking about, markets go up and down in the short term, but trend up over the long term. Looking back from 1872 to 2022, while yearly returns have shown fluctuations ranging from -37% to +53.2%, the returns over a 20-year period have constantly been positive. Although historical performance doesn't guarantee future outcomes, it's noteworthy that the US stock market has historically yielded strong returns over the long term. However, if your investment timeline is short, it might be wiser to allocate your savings to less volatile assets. And finally, dollar cost averaging does not guarantee a return. Remember that no investment strategy is foolproof, and dollar cost averaging isn't a guarantee against losses. As always, it's important to carefully assess your risk tolerance, investment goals, desired asset allocation, fees, as well as market conditions before implementing any investment strategy, including dollar cost averaging. And finally, let's talk about investing lump sums. What we've talked about till now relates to your bread and butter regular investing. But what if you run into a windfall? This could take the form of a sizable inheritance, a bonus, proceeds from the sale of a business or real estate, or even winnings from a lottery. Or maybe you're just holding onto some cash and trying to figure out when to invest it. Do you invest this amount as a lump sum, or do you dollar cost average it? Surely dollar cost averaging would be the no-brainer approach, right? Obviously, it would be crazy to dump a large amount of money into the market all at once. Well, it's not so clear-cut. This is a really interesting question, and I'll dive into it in my next video so this video doesn't get too long. Thanks for tuning in. If you found this information valuable, don't forget to like and subscribe. I know we've covered a lot in this video, so if you have any questions, drop them in the comment section below. Thank you for watching and see you in the next video. Bye for now.